The year is 1982. Imagine walking into a bank and seeing a certificate of deposit offering 18% interest. 18%. Not a typo. Not a scam. The real rate you could earn on your money, guaranteed by the United States government. But here's what nobody tells you about that moment in history. While those interest rates looked like free money to savers, they represented something far more sinister happening beneath the surface of the American economy. Both bonds and stocks were imploding simultaneously, something that wasn't supposed to happen according to every economics textbook written up to that point. Wall Street had a sacred rule, an unwritten law that seemed as reliable as gravity itself. When stocks fall, bonds rise. When bonds fall, stocks rise. This inverse relationship had protected investors for generations, allowing them to balance their portfolios, hedge their risks, and sleep at night knowing that at least one side of their investments would cushion the blow when markets turned ugly. But in 1982, that rule shattered like glass hitting concrete. Paul Volcker, the Federal Reserve Chairman standing 6 feet 7 inches tall with a perpetual cigar clenched between his teeth, had made a decision that would reshape the global economy for the next 4 decades. He decided to kill inflation by any means necessary, even if it meant burning down the financial markets in the process. Inflation had been running wild through the American economy like a rabid animal, reaching levels not seen since the Revolutionary War. Prices were doubling every few years. The dollar was becoming worthless. People were buying houses not because they needed shelter but because real estate was the only thing holding its value while paper money disintegrated. Volcker's weapon was simple and brutal. Raise interest rates until the economy screamed for mercy. And raise them he did. The federal funds rate climbed above 20%. 20%. Let that sink in for a moment. Today, people celebrate when they can lock in a mortgage at 7% and call it a crisis. In 1982, the baseline rate that banks charged each other for overnight loans exceeded 20%. This wasn't just aggressive monetary policy. This was economic warfare. The bond market went into free fall first. Think about how bonds work for a second. When you buy a bond, you're lending money to a government or corporation in exchange for regular interest payments and the return of your principal at maturity. The value of that bond depends primarily on one thing: the interest rate environment. If rates go up after you buy a bond, your bond becomes less valuable because new bonds are being issued with higher rates. Why would anyone buy your bond paying 5% when they can get a new one paying 10%? They wouldn't unless you sold it to them at a steep discount. Now imagine you're holding bonds in 1982 as Volcker keeps cranking rates higher and higher. The bonds you bought last year paying 12%? Worthless compared to bonds now paying 16%. The bonds you bought last month paying 16%? Already obsolete because rates just hit 18%. Bond investors watched their portfolios melt like ice cream on hot asphalt. The losses were catastrophic. Institutional investors, pension funds, insurance companies, all of them sitting on billions of dollars in bonds that had lost 30, 40, sometimes 50% of their value in just months. But here's where the story gets truly terrifying. The stock market should have been the safe haven. According to decades of market history, when bonds crash, investors flee to stocks. Stocks represent ownership in real companies with real assets, real earnings, real products. They're supposed to hold value even when interest rates spike because companies can adjust, they can raise prices, they can adapt. Except in 1982, stocks weren't adapting. They were dying. The Dow Jones Industrial Average, the most watched stock index in the world, had been trapped in a nightmarish range for over a decade. In 1972, the Dow hit 1,000 points. 10 years later, in 1982, it was still hovering around 1,000 points. An entire decade of zero returns. But the real story was worse than zero returns because inflation had been ravaging the purchasing power of every dollar. If you had invested $10,000 in the stock market in 1972, your investment might still show $10,000 on paper in 1982, but the actual purchasing power of that money had been cut in half. You had lost 50% of your wealth while standing still. Unemployment was pushing double digits. Factories were shutting down across the industrial heartland of America, leaving entire cities economically devastated. The Rust Belt was beginning to rust. Major corporations were going bankrupt. The savings and loan industry was imploding. Real estate markets were frozen because nobody could afford mortgages at 18% interest. And here's the truly insane part. Everyone knew this pain was intentional. Volcker wasn't trying to save the economy. He was trying to break it. He was trying to induce a recession so severe, so painful, that it would strangle inflation to death. The question people asked in hushed voices around trading floors and boardrooms wasn't whether a recession was coming. It was whether America would survive what was coming. Some economists genuinely feared that Volcker's medicine might kill the patient, that the United States might spiral into a depression that would make the 1930s look gentle by comparison. Fast forward to right now. Today. This moment. And pay very close attention because the pattern is repeating with eerie precision. The bond market in recent years has experienced its worst crash since the early 1980s. Not similar to the 1980s crash. Not reminiscent of it. Actually rivaling it in severity. In 2022 alone, the Bloomberg Aggregate Bond Index, which tracks investment-grade bonds, fell by over 13%. That might not sound catastrophic until you realize that bonds aren't supposed to fall 13%. Bonds are supposed to be the boring, safe part of your portfolio. The part that protects you when stocks crash. But stocks also crashed in 2022. The S&P 500 fell nearly 20%. The Nasdaq, heavy with technology stocks, plummeted over 30%. The classic 60-40 portfolio, 60% stocks and 40% bonds, the portfolio structure that had protected retirees and conservative investors for generations, had its worst year since the Great Depression. Both sides of the portfolio collapsed simultaneously, just like 1982. The Federal Reserve, now led by Jerome Powell instead of Paul Volcker, made the same decision Volcker made 4 decades earlier. Inflation was running wild again, hitting levels not seen in 40 years, and the Fed decided to crush it with aggressive interest rate hikes. In March 2022, the federal funds rate was near zero. By late 2023, it had rocketed above 5%. The fastest rate hiking cycle in modern history. And just like in 1982, this created a nightmare scenario for bondholders. Think about all the bonds issued during the 2010s when interest rates were at historic lows. Governments and corporations issued trillions of dollars in debt paying 1%, 2%, sometimes less. Now those bonds have to compete with new bonds paying 5% or more. The mathematical result is brutal. Long-term treasury bonds, supposedly the safest investment in the world, lost over 40% of their value from their peak. 40%. The safe part of investor portfolios got destroyed. But there's something happening right now that makes this moment potentially more dangerous than 1982. The scale of the debt is incomprehensibly larger. In 1982, the total U.S. national debt was just over $1 trillion. Today it exceeds $34 trillion. The entire structure of the modern global economy is built on a foundation of cheap debt. Governments borrowed trillions. Corporations borrowed trillions. Individuals borrowed trillions for homes, cars, student loans, credit cards. All of that debt was accumulated in an era of historically low interest rates, and now those rates have spiked. Here's what keeps economists awake at night. In 1982, Volcker could break inflation because the U.S. economy was still fundamentally strong beneath the surface. Yes, there was pain, tremendous pain, but the country had massive manufacturing capacity, low debt levels, and room to recover. Today, the debt levels are astronomical, manufacturing has been hollowed out, and the entire financial system has become addicted to cheap money like a junkie addicted to heroin. What happens when you force a junkie into withdrawal? They don't quietly recover. They convulse. The commercial real estate market is already showing cracks. Office buildings in major cities are sitting empty as remote work has permanently changed how companies operate. These buildings were financed with cheap debt that now needs to be refinanced at much higher rates. Many of these properties are underwater, worth less than the loans secured against them. Banks holding these loans are starting to panic. Small and regional banks are particularly vulnerable. Remember Silicon Valley Bank? That was just the beginning, a warning shot that most people ignored. The housing market is trapped in a bizarre paradox. Home prices remain elevated because existing homeowners are locked into mortgages at 3% or 4% and refuse to sell and take on a new mortgage at 7% or 8%. This has frozen the housing market, creating a shortage of available homes even as affordability has collapsed. First-time buyers are completely priced out. The American dream of homeownership is becoming a fantasy for an entire generation. But here's where the 1982 pattern gets truly interesting and potentially terrifying. In 1982, the crash created the setup for one of the greatest bull markets in history. When Volcker finally pivoted and started cutting rates in late 1982, the stock market exploded upward. The Dow went from under 1,000 to over 11,000 over the next 18 years. Bonds also rallied spectacularly as interest rates fell from their peaks, creating 40 years of gains for bond investors. The pain of 1982 was the reset that launched 4 decades of prosperity. The question everyone should be asking is whether we're at a similar inflection point right now. Has the Federal Reserve inflicted enough pain to kill inflation? Are we about to see a pivot that launches the next great bull market? Or is this time fundamentally different because the debt levels are unsustainable, because the global economy is more fragile, because the problems are deeper than they were in 1982? Look at what's happening with inflation right now. It peaked above 9% in 2022, the highest level in 40 years. The Fed's aggressive rate hikes brought it down to around 3%. But it's proving stubborn at that level, refusing to drop all the way back to the Fed's 2% target. This is creating an impossible dilemma. If the Fed keeps rates high to fight inflation, they risk breaking something in the financial system. If they cut rates too soon, inflation could roar back to life. In 1982, Volcker had credibility. When he said he would do whatever it took to kill inflation, markets believed him. That credibility allowed him to eventually pivot without sparking fears of runaway inflation. Does Jerome Powell have that same credibility? The jury is still out. Markets watch every word he speaks, parsing his statements like ancient priests reading entrails, trying to predict when the pivot will come. The geopolitical situation adds another layer of complexity that didn't exist in 1982. The world is fragmenting. Globalization, the force that helped keep prices low for decades, is reversing. Supply chains are being reshored. China and the United States are decoupling economically. Wars in Ukraine and the Middle East are disrupting energy and food supplies. All of these factors create inflationary pressures that are structural rather than temporary. Technology presents another wild card. Artificial intelligence is advancing at a pace that's difficult to comprehend. Some economists argue that AI will be massively deflationary, automating jobs and increasing productivity so dramatically that prices will fall. Others warn that the disruption will cause social and economic chaos that could be inflationary. Nobody really knows because we've never experienced anything like this before. The wealth gap has exploded to levels not seen since the Gilded Age. The top 1% own more wealth than the entire middle class. This creates economic fragility because consumer spending, which drives 70% of the U.S. economy, depends on a healthy middle class. When the middle class is struggling under the weight of expensive housing, expensive healthcare, expensive education, and now higher interest rates on all their debt, consumer spending falters. And when consumer spending falters, corporate profits fall, stocks fall, and the downward spiral accelerates. Political dysfunction adds yet another risk factor. In 1982, despite partisan differences, there was still a basic consensus that the Federal Reserve should be independent and that sound money was important. Today, that consensus is fraying. Politicians from both parties have called for more political control over the Federal. The temptation to print money to solve problems is always strong, and it grows stronger when economic pain intensifies. Here's what the bond market is telling us right now if we're willing to listen. The yield curve, the relationship between short-term and long-term interest rates, has been inverted for an extended period. This means short-term rates are higher than long-term rates, which is abnormal. Historically, an inverted yield curve has been one of the most reliable recession indicators. It has predicted every recession for the past 50 years with only one false signal. And it's been flashing red for over a year. But markets haven't crashed yet. Stocks have actually rallied from their 2022 lows, confusing many observers. How can stocks rally when the bond market is predicting recession? The answer is that markets are forward-looking. They're betting on the Fed pivot, on rate cuts coming, on a soft landing where inflation comes down without a severe recession. This is an incredibly optimistic scenario and it might be correct. But it also might be setting up investors for devastating losses if that optimism proves misplaced. The corporate debt market is particularly concerning. Corporations issued enormous amounts of debt during the era of zero interest rates. Much of this debt is coming due in the next few years and will need to be refinanced at much higher rates. Companies that were barely profitable at 2% interest rates might not survive at 6% interest rates. Bankruptcy rates are already ticking up. If they accelerate into a wave, the ripple effects through the financial system could be severe. The auto loan market shows similar stress. Americans bought cars with cheap financing over the past decade. Now those loans are underwater, with many people owing more than their cars are worth. Default rates are rising. The same pattern is visible in credit card debt, which has exploded to record levels. When consumers are maxed out on credit cards and struggling to make car payments, they don't have money to spend on other things. Retail spending suffers, restaurants close, service sector jobs disappear. Student loan debt presents a unique crisis. The pandemic-era pause on student loan payments has ended. Millions of Americans who haven't made a student loan payment in 3 years now have to resume payments, pulling hundreds of dollars per month out of their budgets. This is a massive headwind for consumer spending, hitting right as other pressures are intensifying. The parallels to 1982 extend beyond just markets and interest rates. There's a similar sense of malaise, of pessimism about the future. In 1982, Americans were convinced the country was in decline, that the best days were behind us, that the next generation would be worse off than their parents. Books with titles like The Decline of the West and The Zero-Sum Society became bestsellers. Intellectuals debated whether capitalism had failed, whether democracy could survive, whether America would become a second-rate power. That pessimism proved wildly wrong. The 1980s and 1990s were decades of tremendous prosperity and innovation. Personal computers, the internet, biotechnology, all of these transformative technologies emerged from the ashes of the early 1980s recession. American power and influence expanded dramatically. Living standards rose. The stock market produced generational wealth for those who stayed invested. Could we be on the verge of a similar surprise to the upside? It's possible. The ingredients for a boom are actually present. Technology is advancing rapidly. Energy production is increasing. Productivity could accelerate. If the Fed manages to bring down inflation without causing a severe recession, if they can execute the soft landing, then we could see markets rally powerfully just like they did after 1982. But the risks are also more severe than they were in 1982. The debt burden is crushing. The geopolitical environment is more dangerous. The social fabric is more frayed. The political system is more dysfunctional. The margin for error is much smaller. Here's what individual investors need to understand about this moment. When both stocks and bonds crash together, traditional diversification doesn't protect you. The 60-40 portfolio that was supposed to be safe can lose 20, 30, even 40% of its value. This is when people panic, when they sell at the bottom, when they make catastrophic mistakes that destroy their financial futures. The lesson from 1982 is that the worst time to sell is when everything looks hopeless. The people who sold stocks in August 1982 when the Dow was at 770 points, convinced the world was ending, missed one of the greatest bull markets in history. The Dow quintupled over the next decade. The people who held on, who kept investing, who had the courage to buy when everyone else was selling, those people built generational wealth. But that lesson comes with a critical caveat. You have to survive long enough to see the recovery. If you're over-leveraged, if you have too much debt, if you're forced to sell assets to meet margin calls or make payments, then you can't hold on. You get wiped out before the recovery arrives. This is why debt is so dangerous in moments like this. Debt turns market downturns into personal catastrophes. The bond market crash is particularly brutal for retirees and near-retirees. People who spent their careers building up bond portfolios for safe retirement income have watched those portfolios get devastated. A 65-year-old who retired in 2021 with a portfolio of investment-grade bonds has seen their portfolio lose 30 to 40% of its value. They can't make that back. They don't have time. This is a permanent destruction of retirement security for millions of Americans. The psychological impact of simultaneous stock and bond crashes is profound. It attacks the fundamental assumption that there's always somewhere safe to hide your money. If stocks crash, bonds should be safe. If bonds crash, stocks should be safe. When both crash together, people lose faith in the entire system. They start pulling money out of markets entirely, stuffing cash under mattresses, buying gold, moving to money market funds. This withdrawal of capital from productive investments makes the economic situation worse, creating a self-reinforcing downward spiral. Central banks around the world are all facing the same dilemma as the Federal Reserve. The European Central Bank raised rates aggressively. The Bank of England did the same. Even the Bank of Japan, which maintained negative interest rates for years, has finally started to shift policy. This globally synchronized tightening is unprecedented in modern history. Never before have all the world's major central banks raised rates aggressively at the same time. The combined impact on global growth, on global debt markets, on global financial stability, is impossible to predict with confidence. Emerging markets are particularly vulnerable. Many developing countries borrowed heavily in dollars when rates were low. Now they have to repay those dollars with their own currencies that have weakened dramatically, while also dealing with higher interest rates. Several countries are already in or near debt crises. Sri Lanka defaulted. Pakistan is struggling. Others will follow. When emerging markets collapse, it creates ripple effects throughout the global financial system. The currency markets are showing extraordinary volatility. The dollar has strengthened dramatically against most other currencies, which is what typically happens when the Fed raises rates faster than other central banks. A strong dollar helps Americans buying foreign goods but devastates emerging markets and hurts American exporters. It creates deflationary pressure in the United States while creating inflationary pressure in other countries. These cross-currents make global economic management incredibly difficult. Commodity markets are sending mixed signals. Oil prices have been volatile, reflecting uncertainty about global growth. If the world economy slips into recession, oil demand will fall and prices will drop. But if geopolitical tensions escalate, supply disruptions could push prices higher even in a weak economy. Gold, traditionally a safe haven in times of crisis, has been surprisingly subdued, suggesting that maybe investors aren't as worried as they should be, or maybe they've lost faith in traditional safe havens. The crypto market adds a new dimension of risk and volatility that didn't exist in 1982. Bitcoin and other cryptocurrencies were supposed to be a hedge against inflation and traditional financial system failure. Instead, they've proven to be highly correlated with risky assets like tech stocks. When stocks crash, crypto crashes harder. The collapse of major crypto firms like FTX revealed that the crypto industry was riddled with fraud and mismanagement. Billions of dollars in supposed wealth simply vanished. The dream of crypto as a parallel financial system independent of central banks and governments has largely collapsed, at least for now. Private equity and venture capital are facing their own reckoning. These markets boomed during the era of cheap money, with valuations reaching absurd levels for unprofitable companies. Now the reckoning is here. Startups are running out of cash and can't raise new funding. Private equity firms are stuck with portfolio companies they can't sell because the IPO market is frozen and strategic buyers aren't interested at previous valuations. The markdowns are brutal, but they're largely hidden from public view because these are private markets. When the full extent of the losses becomes visible, it could shake confidence further. The pension fund crisis is accelerating. Public pension systems for teachers, police officers, firefighters, and other government workers are massively underfunded. They made optimistic assumptions about investment returns, assuming they could earn 7 or 8% annually. Those assumptions are being shattered. When both stocks and bonds are losing money, pension funds fall further into deficit. This creates a time bomb for state and local governments that will eventually explode in benefit cuts, tax increases, or both. Insurance companies face similar pressures. They hold enormous portfolios of bonds that have lost value. They also face claims from natural disasters that are becoming more frequent and severe. Some insurance companies are pulling out of entire markets like Florida, where hurricane risk has become uninsurable at profitable rates. When insurance becomes unavailable or unaffordable, it creates cascading effects through real estate markets and the broader economy. The shadow banking system, the network of financial intermediaries outside traditional banking regulation, is another source of potential crisis. Money market funds, hedge funds, private credit funds, all of these entities play crucial roles in financial markets but are less regulated and less transparent than traditional banks. When stress hits the financial system, these shadow banks are often where cracks appear first. The collapse of Archegos Capital in 2021 and the run on money market funds in 2020 were warning signs that this system is fragile. Here's the brutal truth that nobody wants to say out loud. The global financial system is built on a foundation of debt and leverage that may be fundamentally unsustainable. For 40 years since 1982, the solution to every crisis has been to lower interest rates and add more debt. .com crash? Lower rates and add debt. Financial crisis? Lower rates and add debt. Pandemic? Lower rates and add debt. But now rates are high and we're approaching the limits of how much more debt the system can absorb. If you graph total debt, government plus corporate plus household, as a percentage of GDP for developed economies, the line goes up and up and up. It's now well over 300% in many countries. This means the economy owes 3 times as much as it produces annually. That's sustainable only if interest rates stay low. When rates rise as they have now, the interest payments on all that debt become crushing. Japan has been running this experiment for decades with debt to GDP ratios above 200%, kept manageable only by near zero or negative interest rates. Japan has shown that a major economy can sustain extraordinary debt levels, but only by accepting essentially zero growth and zero interest rates forever. Is that the future for the United States and Europe? Eternal stagnation with no way out? The alternative is some form of debt restructuring, which is just a polite way of saying default. Either explicit default, where governments and corporations simply say they can't pay their debts, or implicit default through inflation, where debts are repaid with currency that has been deliberately devalued. Both options are catastrophic in different ways. Explicit default would cause a financial crisis that makes 2008 look like a minor hiccup. Implicit default through inflation would destroy savings and spark social unrest. But maybe there's a third path, the path that emerged from 1982. Maybe we're at the point of maximum pain, where Volcker's medicine finally worked, where inflation was broken, where the stage was set for a new era of growth. Maybe technology, specifically artificial intelligence, will drive a productivity boom that allows the economy to grow its way out of the debt trap. Maybe we're worrying too much, and the resilience of the market economy will once again surprise us to the upside. The indicators to watch are clear. First, watch inflation. If it continues to fall toward the Fed's 2% target, that gives the Fed room to cut rates and ease financial conditions. If it stays stubbornly high or starts rising again, we're in serious trouble. Second, watch the labor market. So far it has remained surprisingly resilient, with unemployment still relatively low. If unemployment starts spiking, that's the signal that recession is here. Third, watch credit markets. If corporate bond spreads start widening dramatically, if high-yield bonds start seeing major defaults, that's the sign that financial stress is escalating into financial crisis. The banking system is the critical transmission mechanism. Banks borrow short and lend long. They take deposits that can be withdrawn at any time and make loans that won't be repaid for years or decades. This makes them inherently vulnerable to runs. If depositors lose confidence and start withdrawing money en masse, banks fail. We saw this with Silicon Valley Bank. The question is whether that was an isolated incident or the first domino. Bank stocks are worth watching as a real-time indicator of financial system health. When bank stocks crash, it's usually because investors see trouble ahead in loan portfolios. Regional bank stocks have been under pressure, suggesting that investors are worried about commercial real estate loans, about the inverted yield curve crushing bank profitability, about deposit flight to higher-yielding money market funds. The Fed has tools to deal with bank runs. They can provide emergency lending to banks facing liquidity crunches. They can guarantee deposits beyond the normal FDIC limits. They can essentially print money to prevent bank failures. But all of these tools come at a cost. Using them means abandoning the fight against inflation. It means accepting that the financial system is too fragile to withstand normal interest rates. It means we're trapped in a doom loop where we can never normalize monetary policy without causing a crisis. This is the deeper pattern from 1982 that's repeating now. The Volcker shock worked because he had the credibility and the courage to push the economy to the breaking point and hold there until inflation broke. He didn't flinch when unemployment hit double digits. He didn't cave when politicians and business leaders demanded rate cuts. He held firm until the job was done. Then and only then did he pivot. The question for Jerome Powell is whether he has that same resolve. Can he hold rates high enough for long enough to truly break inflation, even if it means accepting a severe recession? Or will he blink? Will he cut rates at the first sign of serious economic pain, and thereby risk letting inflation become entrenched? The market is essentially betting that he'll blink, that the Fed will prioritize avoiding recession over truly defeating inflation. That bet might be right. But if it's wrong, if Powell really does channel Volcker and holds firm, the pain ahead could be extraordinary. Here's what makes this moment so psychologically difficult for investors. There's no clear playbook. In a normal stock crash, you buy bonds. In a normal bond crash, you buy stocks. When both crash together, what do you buy? Cash seems safe, but inflation erodes its value. Gold is supposed to be the ultimate safe haven, but it hasn't performed well. Real estate is overvalued and facing rising mortgage rates. Commodities are volatile and depend on global growth that might evaporate. The answer from 1982 was that you had to have faith in the system, faith that capitalism and innovation would eventually win, faith that America would figure it out. That faith was rewarded spectacularly. But faith is a hard thing to maintain when your portfolio is down 30% and every news headline is predicting doom. The social and political consequences of the 1982 crash were profound. The pain fell disproportionately on the working class and the poor. Factories closed, manufacturing jobs disappeared, entire communities were destroyed. This created lasting political anger that we're still dealing with today. The populist movements on both the left and right trace their roots to the economic dislocations of the early 1980s. The collapse of the American industrial heartland, the rise of the service economy, the growing inequality, all of these trends accelerated during and after the Volcker shock. If we're repeating that pattern, the social consequences could be severe. We're already seeing political polarization at levels not experienced since the Civil War. Economic pain tends to radicalize politics, pushing people toward extremes. When people can't afford housing, can't pay their bills, can't see a path to a better future, they become susceptible to demagogues promising simple solutions. Democracy itself becomes fragile. The global implications are also enormous. In 1982, American monetary policy decisions rippled through the world, causing debt crises in Latin America and other developing regions. Today, with global financial markets more interconnected than ever, the ripple effects will be even larger. When the Fed raises rates, it strengthens the dollar, making dollar-denominated debt more expensive for the rest of the world. It also pulls capital out of emerging markets as investors chase higher yields and safer American assets. China presents a particular wild card. The Chinese economy is slowing dramatically after decades of extraordinary growth. The real estate sector, which drove much of Chinese growth, is in crisis. Major developers have defaulted on billions in debt. Local governments are drowning in debt from infrastructure spending. The population is aging rapidly. If China's slowdown accelerates into a serious recession, the impact on global growth would be massive. China is the world's second-largest economy and the largest trading partner for most countries. A Chinese recession would mean a global recession. The technological disruption from artificial intelligence could be either massively deflationary or massively disruptive depending on how it unfolds. If AI increases productivity dramatically while destroying jobs slowly enough for the economy to adjust, it could be hugely beneficial. If it destroys jobs faster than new jobs can be created, it could cause social and economic chaos. We're in the early stages of this transformation, and nobody really knows how it will play out. Climate change adds yet another layer of complexity. Extreme weather events are becoming more frequent and severe. The costs of these events, in terms of direct damage and insurance claims and economic disruption, are rising exponentially. Adapting to climate change will require enormous investments in infrastructure, in new technologies, in relocating populations away from vulnerable areas. Where does the money for all of this come from in a world already drowning in debt? The answers to these questions will determine whether we're truly repeating the 1982 pattern or whether we're in something worse, something unprecedented. The optimistic case is that we're at the inflection point, that the worst is behind us, that the next great bull market is about to begin. The pessimistic case is that the debt levels are too high, the problems are too deep, the system is too fragile, and we're heading for a crisis that will make 2008 look like a warm-up act. What's certain is that we're living through a historical moment. Future generations will study this period, will write books about it, will debate what went wrong and what went right. The decisions being made right now by central bankers, by political leaders, by corporate executives, by individual investors, these decisions will shape the economic landscape for decades to come. For those watching their portfolios shrink, for those worried about their jobs, for those trying to figure out how to protect their families and their futures, the message from 1982 is both hopeful and cautionary. It's hopeful because it shows that even the darkest economic moments can give birth to tremendous prosperity. It's cautionary because surviving to see that prosperity requires making smart decisions, avoiding panic, managing risk, and having the courage to stay invested when everyone else is running for the exits. The bond and stock crash of 1982 was the reset that launched 40 years of growth. If history is truly repeating, then the pain we're experiencing now is the price we pay for the boom to come. But history doesn't repeat exactly. It rhymes. The question is whether we're hearing a rhyme that ends in prosperity or a different rhyme entirely, one that ends in a darker place that we haven't imagined yet. The answer will be written in the months and years ahead, in the decisions made and opportunities seized or squandered. We're living through the moment when that answer is being determined, whether we realize it or not.